Let's go ahead and talk about defined benefit pension plans. Now, in defined benefit pension plans, retirees are promised a defined or specified amount when they retire. Generally, these take the form of a payment of so many dollars per month until they die. Pensions are generally based on how many years of service the person has, as well as on their final salary. The longer the employer works for a company, the greater is their periodic pension payment. The more they make when they retire, the greater is their pension benefit. The employer contributes money to the pension plan, which is administered by some third-party trustee, whether it's an insurance company or a bank or some other sort of financial intermediary. The trustee invests those funds. Now, the more the trustee makes on the investments, the less the employer has to contribute. If the trustee makes a bad investment and loses the money, the employer has to make up that shortfall. Again, the retirees are promised a specified or defined benefit when they retire, and it's the employer's responsibility to make sure those funds are available. And the trustee pays benefits to the retirees out of these pension plan assets. Now, one of the problems is that the employer doesn't know what the plan will ultimately cost them. Again, they're going to have to be sure that there's enough money available to pay the benefits when they come due. This is going to have a number of things which cause uncertainty. Generally speaking, the longer a person works, the greater will be the retirement benefits. The shorter the working period, the lesser will be the retirement benefits. The greater the final salary, the greater the pension benefits. If the employees quit before they earn their pension benefits, then the cost of the plan will be low. Generally speaking, firms which offer defined benefit pension plans, you have to be there for some number of years called the vesting period before you're legally entitled to any benefits, whether that's 5 or 8 or 10 years. So if you've got a 5-year vesting period and your employees all quit before they hit that 5-year vesting mark, then you won't have any pension obligation at all. Now, if the retiree lives a long time after retirement, then you're going to be making these pension payments for a long time, and the total benefits will be large. Conversely, if they live a fairly short time after retirement, the benefits paid out will be less. Getting back to the pension plan trustee and their assets, if the pension plan trustee earns a high rate of return on the pension plan assets, then that's less that the employer has to contribute. If the pension plan trustee loses all the money, then the employer has to make up that shortfall. If the pension plan allows for cost of living adjustments to benefits, then future inflation rates will dictate what the future pension payments are going to be. Now, we have some definitions we have to work with, and these, we're going to have 3 different measures of the pension obligation. First is the vested benefit obligation, or VBO. This is the present value of the vested pension benefits. Again, let's say your company has a 5-year vesting period. These are the pension benefits that have accrued to those people who have reached that vesting period. A little more inclusive would be what's called the accumulated benefit obligation, and again, this is the present value. These are long-term obligations, so we always measure long-term obligations at present value. The accumulated benefit obligation is the present value of both vested and unvested pension benefits based on current salaries. So now we're throwing into the mix those employees who have not yet reached the vesting period of 2 or 3 or 5 or 10 years, whatever the vesting period happens to be. Now, this measure still understates the potential total pension obligation because this is based on current salaries. When the person retires in 10 or 15 or 20 years, the people's salaries will be higher because of annual wage growth. So the most inclusive, the most conservative from an accounting standpoint measure of the pension obligation is what's called the projected benefit obligation. And again, this is the present value of both vested and unvested pension benefits based on expected final salaries. Now, these numbers are taken as a given. We hire an actuary who is basically a specialized statistician to look at our workforce and our various assumptions regarding wages and turnover, and the actuary tells us what these numbers are. Now, when we do our defined benefit pension plan computations, we're going to keep track of this using what's referred to as a pension worksheet. And basically what we're going to have is a number of columns. We're going to have a column for pension expense, a column for the cash payment or the funding of the pension plan. Again, the employer gives money to the pension plan trustee to invest. We're going to have the projected benefit obligation. Now again, of those three measures of the obligation, the vested benefit obligation, the accumulated benefit obligation, and the projected benefit obligation, the only one we really make any use of is the projected benefit obligation. We're going to have to keep track of the pension plan assets, and we're going to have two other things which we'll talk about in due time. Accumulated other comprehensive income, AOCI, unamortized prior service cost, and accumulated other comprehensive income, pension gain or loss. Now, there are going to be 5 components to pension expense. Let me go ahead and introduce them one by one over a number of years. The first of our components of pension expense is what's called the service cost, and this is defined as the increase in the projected benefit obligation, or PBO, due to employee service in the current year. Again, generally speaking, the longer an employee works for you, the greater will be his pension benefit. So by virtue of people working for you for another year, they've earned some more pension benefits, which causes the present value of the pension obligation to increase. So let's assume that in 2020 we establish a defined benefit pension plan. On 12/31/20, the last day of the year, we contribute $100,000 to that pension plan, and our actuary tells us the service cost was $80,000. So our first of 5 components of pension expense is service cost, and again, that's a component of pension expense, so $80,000 debit under pension expense, and that's defined as the increase in the projected benefit obligation. Now again, the obligation is it's a liability, so it's going to have a credit balance, so a credit is positive. We do our funding or our contribution, and again, we're going to take $100,000 out of our company checkbook, and we're going to go ahead and give that to the pension plan trustee, and he or she or it is going to invest that hopefully in safe and yet high-yielding investments. We bring our balances forward. $80,000 for pension expense, $100,000 credit to cash, $80,000 credit balance in the obligation, $100,000 debit balance in the pension plan assets. And we're going to go ahead and report what's called a pension asset/liability in the amount by which the pension plan is either overfunded or underfunded. Essentially what we're going to do is look at the projected benefit obligation, the measure of what we owe, and net that against the pension plan assets, what we have available to pay that obligation. So in this case, we have an $80,000 obligation. We have $100,000 in assets set aside or earmarked or tagged to meet those obligations. So we've got $20,000 extra. So this is going to be referred to as a pension asset on our balance sheet. So to record this, we're going to go ahead and record pension expense, $80,000. We write a check to our pension plan trustee for $100,000, and we debit the pension asset/liability for $20,000. Now, I call that pension asset/liability because some years it will be an asset balance when we have more assets than obligation. Other years it will be a credit balance, a liability balance, when we have more obligation than we have assets. So that sort of universal account title of pension asset/liability is suitable, no matter which side of the balance sheet that account is on. Okay, let's go ahead and get 2 more components of pension expense. First, we have our service cost, of course. Number 2 is what's called the settlement cost or the interest cost. The projected benefit obligation is a present value. So looking at that chart down at the bottom of the page, the PBO of $80,000, that was the present value as of January 1st. Now, by the time you get to the end of the year, that present value will increase because we're that much closer, 1 year closer to when those payments are going to be made. The interest cost or settlement cost is going to be the beginning of year projected benefit obligation times the settlement rate, and in this example it says the settlement rate is 10%. The third component of pension expense is going to be the return on pension plan assets. Again, we give our pension plan trustee money and tell them to go forth and invest it in profitable and yet safe investments. Every dollar they earn is $1 less that we're going to have to contribute. So the return on pension plan assets is going to be treated as a reduction in pension expense. So let's go ahead and go through this worksheet for the second year. First, we have our service cost. Again, the service cost is always given and is defined as the increase in the projected benefit obligation due to employee service in the current year. A $100,000 debit or positive number under pension expense, a $100,000 credit or positive number under projected benefit obligation. And again, the nice thing about, one of the useful features about these worksheets is that on every line that we enter in the worksheet, aside from the beginning balance obviously, debits must equal credits. So in that service cost line, we have a $100,000 debit matched by a $100,000 credit. Next we have our settlement cost, or our interest cost. So we're going to take our settlement rate of 10%, multiply that by our beginning of year projected benefit obligation of $80,000 for $8,000. And again, that's a positive component to pension expense, and that increases the obligation because, again, that's basically the increase in the present value of the obligation from the beginning of the year to the end of the year. It's essentially, in a sense, the accrual of interest on the obligation. Next we have our return on pension plan assets, and it says return on assets 10%. Our pension plan trustee had $100,000 of our money at the beginning of the year. They earned 10% on that, so the return on assets is a credit under pension expense. Again, it reduces pension expense. And over in the pension plan asset column, we add $10,000 to our assets because, they increase the assets by $10,000. Next, we make our contribution. Again, we take our company checkbook and write a check for $140,000 and give that to the pension plan trustee. And we bring our balances forward. So again, this is where you need to watch the D's and the C's in these various columns. Under pension expense, we have $100,000 plus $8,000 minus $10,000 is $98,000. Cash, $140,000. The projected benefit obligation, $80,000 plus $100,000 plus $8,000 is $188,000, and the pension plan assets, $100,000 plus $10,000 plus $140,000, $250,000. Now again, in terms of the pension asset / liability, at the beginning of the year, looking at the beginning balances, we had $80,000 in obligation, $100,000 in assets, so we had a $20,000 debit balance in that pension asset / liability. At the end of the year, we have $250,000 in assets and $188,000 in obligations, so now we're overfunded. We have assets in excess of the obligation of $62,000. So the balance in that pension asset / liability needs to go from a $20,000 debit balance to a $62,000 debit balance, an increase of $42,000 on the debit side. So we'll go ahead and record pension expense of $98,000. We do that $42,000 debit to the pension asset / liability, and we write a check for $140,000, giving that to our pension plan trustee. Now, for the return on pension plan assets, we generally use the expected rate of return in the computation of pension expense and the actual rate of return to keep track of the pension plan assets. So now we're in our third year, 2022. We bring our beginning balances forward. The PBO has a balance of $188,000. The pension plan assets a balance of $250,000. Now the reason for this use of the expected rate of return on assets for the computation of pension expense is, again, this is a very long time horizon problem. If you have an employee who comes to work for you at the age of 23, they might work for you for 40 years, retire at the age of 63, and then live for another 25 years on top of that till they're 88. So you might be looking at a time horizon for this employee's relationship with your company of 65 years. So it's a very long-term time horizon, and the argument was that, the stock market gyrates on a year-by-year basis. Some years are very, very good, some years are very, very bad. Do we want to have our pension expense, and therefore our net income, affected by short-run fluctuations in the stock market. And the response of the FASB was that instead of accepting that, the companies are allowed to go ahead and use the expected long-term rate of return as the amount that they credit to pension expense. The idea being that if we expect, in this case it says expected rate of return 10%, we might expect a 10% rate of return in the long run. Some years we make a lot less than that, some years we make a lot more than that. But on average, in the long run, we expect 10%. So let's go ahead and go through our three components of pension expense again, but now go ahead and use this slight modification of the return on pension plan assets. Again, service cost, always the same way, a debit to pension expense, a credit to the projected benefit obligation. The settlement cost, notice that I've dropped the settlement rate. Last year the settlement rate was 10%. Now the settlement rate has dropped to 8%. So the settlement cost or interest cost, 8% of the beginning of year projected benefit obligation, $15,040. Again, that's a debit. It's increasing pension expense, and that gets added to the obligation as a credit. Return on assets, again, we're going to use the expected return on assets under pension expense. So at the beginning of the year, they had $250,000 of our money, and we expect them to make 10%, or $25,000. So that's the amount we deduct from pension expense. Over in the pension plan assets column, we need to actually keep track of what the pension plan trustee actually has. So that's where we put the $40,000 actual return on assets. Again, for each one of these lines, debits must equal credits. So in this case, that's not working. We've got a $25,000 credit, we got a $40,000 debit. So to make this ROA line balance, we need another $15,000 credit. We're going to go ahead and credit that to accumulated other comprehensive income, pension gain or loss. Now the idea is that, again, in the long run we expect to make 10%. Some years we might make a lot more than that, other years we might make a lot less than that. In the long run though, gains in one year should be offset by losses in another year. This was a good year. We expected to make $25,000, actually made $40,000. We're happy. We're going to take that $15,000, what's called an asset gain, and we're going to put it not into pension expense. We're going to put that in other comprehensive income. And the idea is we're going to leave that in other comprehensive income, hoping that a gain this year will be offset by a loss next year. And only if that account gets to be too large, which we'll talk about next year, only if that account gets to be too large will we subject it to amortization. But we're just going to sort of let that ride, sort of assuming that we have gains, we have losses. They should sort of fluctuate around zero. Funding, we take our checkbook, we write a check for $100,000 and give that to our pension plan trustee. And now we have the final thing. If you'll notice in the small table in the middle of the page, the last item, bottom right-hand side, says ending PBO $400,000. Now, all of those entries to the PBO column are based on estimates. We estimate things like working life, we estimate mortality, we estimate turnover, we estimate rates of salary growth. We have all these various estimates that we use in determining service cost and things like that. Those estimates are subject to revision. One of the estimates we had was the settlement rate. Again, the PBO is a present value. Last year, that present value was measured based on a settlement rate or a discount rate of 10%. We've lowered the discount rate to 8% for whatever reason. Now, because we're using a lower discount rate, the present value is going to be higher. And what we need to do essentially is do a plug figure to reconcile what we've assumed over the course of the year, those entries to the PBO column, to reconcile or adjust that to what our actuarial consultant tells us is the correct end-of-year value. So if you look at the PBO column, we had a beginning balance of $188,000. We added $125,000 for the service cost, and then we added $15,040 for the settlement cost. So according to our worksheet, the projected benefit obligation should be $328,400. Our actuarial consultant tells us, no, the true value is 400,000, so we need to go ahead and increase that by $71,960. So again, we're going to credit or increase the projected benefit obligation by $71,960. That increase in our obligation is an actuarial loss. We owe more than we thought we did based on changes in actuarial assumptions. Now again, we're going to take that actuarial loss and put it over in the pension gain or loss column. The assumption is that gains or losses in one year should be offset by losses or gains in other years, and so that account should fluctuate around zero. We're only going to worry about amortizing it if that account balance gets to be too large. So let's go ahead and bring all of our balances forward. Pension expense, $115,040. Cash, $100,000. The $400,000 PBO balance is something we determined, or our actuarial consultant informed us of. Pension plan assets, $390,000. AOCI, pension gain or loss. Again, you have to watch the debits and the credits here. We started with a zero balance. We added a $15,000 credit. We added a $71,960 debit. So our end of year balance is $56,960. And from those ending balances, we get our pension entry for the year. So over on the right-hand side of the screen, we see pension expense, $115,040. Reading across the table, the next column is the cash column. We write a check for $100,000. Next, we have our pension asset / liability. Again, these presentations are sort of cluttered already. It might be a nice idea if you would go ahead and take a scrap of paper and do a little T account. At the beginning of the year, we had pension plan assets of $250,000, a PBO of $188,000, for a beginning of year pension asset of $62,000 on the debit side. At the end of the year, we've got a $400,000 obligation, $390,000 in assets, and so now if you net those two things together, our desired ending balance is a $10,000 credit balance. So to get from a $62,000 debit balance at the beginning of the year to the desired $10,000 credit balance at the end of the year, we need to credit that pension asset / liability account for $72,000. Finally, the last column, that AOCI - pension gain or loss, that account started at zero. It ended at $56,960 on the debit side, so we need to go ahead and put that on the income statement and balance sheet. Now again, this is part of other comprehensive income, things that look, feel, taste, and smell like income, but for whatever reason we don't want them in the income statement proper. So instead, we put them in the statement of other comprehensive income, and from there they flow through to accumulated other comprehensive income in the owner's equity section of the balance sheet. A little check figure built in. As we plug in those end-of-year balances, into the journal entry, we'd better find that our journal entry balances. If the journal entry doesn't balance, then obviously we've done something wrong in our worksheet. Okay, let's go on to 2023, and now we have our fourth component of pension expense, and that's the gain or loss recognition. And again, the idea is that pension gain or loss, some years it'll be a gain, other years it'll be a loss, it should fluctuate around zero. If it gets to be too big, if it gets to be too far from zero, we say, look, it's gotten so out of hand, we don't think it's going to go back to zero, we need to start amortizing it. Now, how the FASB has, perhaps arbitrarily defined too big is 10%. This is all based on beginning of year balances. So at the beginning of the year, we look at the beginning of year PBO or pension plan assets and take 10% of the larger of those two and treat that as what the textbook refers to as the corridor, what I call the threshold. In any event, as of the beginning of the year, the PBO is $400,000, pension plan assets are $390,000, so the larger of those two is $400,000. 10% of that is $40,000, so that's our threshold. And our beginning of year pension gain or loss is $56,960. So we're over that threshold. We've gotten to be too big. We're going to take the amount by which we exceed the threshold. So again, the threshold is $40,000. The beginning of year gain or loss is $56,960. So we exceed the threshold by $16,960, and we're going to go ahead and amortize that over the average remaining working life of our employees. So Again, 56,960 minus 40,000 is 16,960. Divided by 10 is 1,696 per year. So let's go ahead and go through our four components of pension expense now. Service, always the same. Settlement, always the same. Again, 8% of the beginning of year PBO. Return on assets, we had another great year here. Again, we were expecting $39,000. The pension plan trustee made $90,000 for us, so we have a $51,000 asset gain. And again, we know that's an asset gain, A, because it's a $51,000 credit, and gains are credits, and sort of more intuitively, we expected 39, we got 90, we got an extra $51,000 this year. Now we get to our gain or loss recognition, and again, we're going to take that excess 16,960, divide it over 10 years to get 1,696, and basically we're taking some of that big debit balance in the pension gain or loss column and transferring it over to pension expense. So we credit the pension gain or loss column and we debit the pension expense column for this year's amortization. Now, looking at this, it appears as though we're setting ourselves up for 10 years of amortization at $1,696 per year. That's not the case. Next year we'll go through the same calculation again, and we might have to amortize more, we might have to amortize less, we might in fact have a big gain that we need to amortize. This is we make this calculation and we use it one time, and then we start afresh the next year. So we have our four components of pension expense. We've got some other stuff here too. We do our funding the same way as we always do. And now we're going to go ahead and pay some benefits to some of our retirees. Now when somebody retires and they're paid benefits, we, the company, don't write a check on our checking account to give to them. This money is coming out of the pension plan assets. So basically the pension plan trustee is taking $20,000 out of the pension plan and paying off part of the projected benefit obligation. So a $20,000 credit under pension plan assets because we're consuming those assets, a $20,000 debit under the PBO because we're paying off that liability. Okay, the last step every year is to record our actuarial gain or loss. Now again, the projected benefit obligation is based on numerous assumptions regarding rates of compensation increase, discount rates, employee mortality, employee turnover, inflation expectations, all these various estimates, and those estimates are subject to revision. So looking at our worksheet, the PBO column currently has a balance $400,000 plus $150,000 plus $32,000 minus $20,000, a balance of $562,000. Our actuarial consultant has come to us and said, look, based on our new information, at the end of the year, your correct projected benefit obligation is $550,000. That's in the smaller table at the top, bottom row just about in the center. So basically we need to go ahead and adjust our projected benefit obligation downwards from the current value of $562,000 down to the correct value of $550,000. So we're going to go ahead and put a $12,000 debit to the projected benefit obligation, and this is termed an actuarial gain. We owe less than we thought we did, which, everything else being equal, is a good thing. So that actuarial gain is put over in the pension gain or loss column, where again, gains in some years will be offset by losses in other years. The account should fluctuate around zero. It's only if it gets to be too big that we subject it to amortization. So we bring our balances forward the same as we always do. And again, just be careful with the debits and the credits. And just reading right across the table, pension expense, $144,696. A credit to cash for $150,000. Now we have that pension asset / liability. Again, hopefully you took my advice to heart and have a little T account going for that account. At the beginning of the year, we had a $10,000, or at the end of last year, the beginning of this year, we had a $10,000 credit balance. Now at the end of the year, we've got a $550,000 liability, we have $610,000 in assets, And so what we should have is a $60,000 debit balance. So to get from the existing credit balance of $10,000 to the desired debit balance of $60,000, we have to credit the pension asset / liability for $70,000. Finally, that AOCI pension gain or loss column, at the beginning of the year we had a $56,960 debit balance. At the end of the year we had a $77,36 credit balance. So to get from roughly a $57,000 debit to a $7,700 credit, we've got to credit the OCI pension gain or loss for $64,696. Okay, we have our fifth and final component of pension expense, and this is what's called prior service cost. Now, in many occasions, companies will modify their pension plan to give credit for prior service. Now, in this example, we started our pension plan in 2020, and we may have had employees who had been with us for 10 or 15 or 20 years already, and we didn't make any provisions to give them credit for the work they had done all those earlier years. Basically, our PBO included only service cost, which was the value of the services provided in the current year, plus interest on that. So we didn't recognize or acknowledge any benefits for prior service that our employees had rendered to us. And so we might amend our pension plan and say, look, we're going to go ahead and give you $100,000. We're going to give you credit for your prior time that you worked for us, and the present value of those benefits as of the beginning of the year is $100,000. So the first thing we have to do is update our worksheet here. We're going to go ahead and add $100,000 to the projected benefit obligation. We willingly obligated ourselves to give these benefits to our retirees. And we don't want to simply treat that $100,000 cost as an expense in the current year. The argument is, ideally we'd be able to go back and allocate that expense to the prior years these people worked for us, matching expenses to the periods benefited. We can't do that, or we shouldn't. We don't do that. So instead, the argument is going to be, look, by giving these employees credit for prior service, they're going to be more motivated, they're going to be happier, they're going to work harder. This is going to benefit us over the remaining working life of the infected employees. So we're going to go ahead and put this in unamortized prior service cost, and we will amortize that to pension expense over the remaining working life of the affected employees. And again, let's go ahead and assume that's 10 years, just like we did previously. So let's run through our 5 components now of pension expense. Service, $200,000. Settlement. Now, here, the settlement cost of $52,000, this is interest at 8%. On the beginning of year PBO. Now, the beginning of year PBO was $550,000, but we tacked on $100,000, and that $100,000 was measured as of January 1st. So that means that by the end of the year, that $100,000 is going to grow by 8%, or $8,000. So we have to take 8% of $650,000, or $52,000. Return on assets, as always, and again, we're doing another good year in the stock market. We expect them to make $61,000 for us. They actually made $80,000. They made an extra $19,000. That's another asset gain for us. Gain or loss recognition. Again, our threshold or our corridor is 10% of the larger of the beginning of year PBO or pension plan assets. Our beginning of year PBO, $550 plus that prior service cost credit, $650,000. So our threshold is 10% of $650,000 or $65,000. Our beginning of year gain or loss is only $7,700. So clearly we're not over that threshold. So the pension gain or loss is small enough. We're not going to worry about amortizing it. So no gain or loss recognition this year. Finally, we have our prior service cost amortization. We have that $100,000 debit up at the top of the unamortized prior service cost column. And again, you can think of that almost as a deferred expense. But rather than putting it on the balance sheet as an asset deferred expense, it's going to be a debit balance in accumulated other comprehensive income. But in any event, we're going to take that $100,000 debit balance and we're going to allocate it to pension expense, $10,000 per year for 10 years. We pay our benefits, again, $40,000 in benefits. We take $40,000 out of the pension plan assets and use that to pay off part of our obligation. We do our funding the same way we always do. And then at the end of the year, we always have our actuarial gain or loss. Again, looking at our PBO column, we had 550 plus 100 plus 200 plus 52 minus 40. So according to our worksheet, the projected benefit obligation should be $862,000. Our actuarial consultant, looking at the middle of that smaller table up top, our actuarial consultant told us that the ending PBO should in fact be $700,000. So we've got to take $162,000 away from that PBO. And again, since we owe less than we had anticipated, this is good as far as we're concerned. This is going to be an actuarial gain, which again we put in that pension gain or loss column. And if it gets to be too big, we'll start to amortize it. So bringing our balances forward, same as we always do, and we do our entry just reading off this table. Pension expense, $201,000. A credit to cash of $120,000. The pension asset / liability. Again, at the beginning of the year, hopefully you still got that T account going. At the end of last year or beginning of this year, we had a $60,000 debit balance. At the end of this year, we have $770,000 in assets, $700,000 in obligations. So you net those two things together, $70,000 debit. So we need to get our pension asset / liability from a $60,000 debit to a $70,000 debit. We need to add $10,000 on the debit side. The unamortized prior service cost. Again, just reading across from column to column. The AOCI, we started at 0. We ended with a $90,000 debit balance, so we need to go ahead and put that $90,000 debit balance on the books. So we debit the OCI-unamortized prior service cost. And then finally, the other comprehensive income pension gain or loss. We had a beginning of year balance of $77.36, end of year balance $188,736. So basically, we need to go ahead and credit that account for $181,000 to get it from the beginning of year balance to the end of year balance. Again, this is the end of this example, but just looking ahead to next year, will we have to recognize some of the gain or loss? Now again, next year we're going to look at the beginning of year balances. Our threshold, or our corridor, will be 10% of the larger of the PBO or the pension plan assets. So next year's beginning of year values will be $700,000 for the obligation, $770,000 for the assets. So 10% of pension plan assets is $77,000. Our beginning of year pension gain or loss is $188,000. So we are way the heck over our threshold. We're going to have to take that excess of about $111,000 and amortize that over a 10-year time frame.